By the end of this video, you will understand options through a IPL bet. I have chosen this cricket as an analogy as because many people in India or most of the people in India likes cricket or at least knows cricket. So this will be easier for them to understand the basics and correlate how this can be used for options as well. So first we'll see what are the terminologies that we'll be covering in this. So main things in options are like call option, put option, strike price, premium, expiry, and this is like in the money, at the money, OTM is out of the money. This is moneyness of a contract. And there is some other terminologies called time decay, implied volatility, intrinsic values, and many much more, which we will be covering. So before getting into that, I'll just explain in a small few lines on what these are. Like, so call option is something like you can consider like this is something like say suppose you are planning to buy a piece of land where they have promised that there is an upcoming airport or an upcoming mall or something that will be like a kind of useful. So the price have recently increased and you are also interested in that, and they are saying like you need not buy the entire properties value, you can just give a token advance, and these things that whatever they have promised will be coming in the upcoming a year or two. So if it is coming, then the price will be staying the same as if you are booking now, if you're giving a token advance. If you are not, if you but if it is not coming, you might not need to buy the land. Say suppose it is a like say 10 lakhs of land, and if you're just giving 50,000 as an advance, they are saying like if whatever we are promised is not coming, then you need not get this land for 10 lakhs. Maybe because that time the price of the land also might be like only 5 lakhs or 6 lakh, but this 50,000 that you are paying will not be refundable. So in that case, like you, if you are exercising that option that we can call as an call option, the amount, the token advance that you pay is called as a premium. And put option is something similar, like an unforeseen event, like a kind of you buy a term insurance policy or your vehicle insurance. Like suppose if something goes wrong, then that premium that you are paid will help you in claiming the amount. So kind of that you can use as a put, like what is a put option. And as I said, like strike premium is the one that you paid for it, and strike price is something that doesn't move. I'll explain more when we come to that IPL betting. And as I said, these are like ITM, ATM, OTM, or in the money, at the money, and out of the money. This is like where your contract stands every time when the spot price moves. So that also you will see in a detailed way. And time decay is something again like it is very crucial in options trading. So just imagine like an ice melting on a table without you touching it. So no matter what you do or whatever what you do or what you don't do, also the ice will ultimately is going to melt. So similarly, the options premium every single day it is going to reduce its value no matter what you do. So that is called as time decay. So now let's get into the video on a cricket IPL bet. So let's imagine like we are in a IPL thing where SRH, which is Sunrisers Hyderabad, is like playing against Mumbai Indians. So we'll just have that as an example. So let's say like uh, we are betting like by end of 5 overs, Sunrisers Hyderabad will score 50 runs. That is the bet that we are making, and you are paying 1,000 rupees as the bet money, which is the premium. So this is like seventh match of the season, like not for the season of for each of the team. So SRH would have played 6 teams before this, and MA again would have played 6 matches before this, and they both are meeting each other as the seventh match. So now what you paid is 1,000 rupees. Now, like after 3 matches, you can see like Travis Head and Nishan Kishan are in a very good form, and they are like kind of scoring boundaries every corner of the ground. So in that case, like the form of them are very good. So like after the 3 matches, all the 3 matches they would have scored above 50 runs in the first 5 overs. So obviously there might be a chance like in your seventh match against Mumbai also they will do the same. So in that case, the premium that you paid has already increased. And one important thing in options is like you can whenever you want you can exit. So you already paid 1,000 rupees. Now it is at 2,000. You can right now also you can exit the amount, like you can get that 2,000. You made a profit of 1,000 and you can exit, or you can still hold this, and maybe if fourth match or fifth match everything is in your favor, this premium will again increase. So it's totally up to you. Any point in time you can like exit the trade. Whether you are in profit or you are in loss, you can exit. That is one good thing in options. And the fourth and fifth match was like, unfortunately, SRH were like not playing up to their mark, and after 5 overs they just scored 30s, somewhere around 30s. So premium falls from 2000 to 1600. And sixth match again, another big blow for SRH. Travis Head is injured, and they are saying like it is unlikely that he will continue with SRH. So now the premium further declines, but still, even now, it is like it is trading at 1200. These numbers are like, I'm just making up some numbers. Maybe this is the reason is like Ishan Kishan is still there, and he would have scored the fourth and fifth match also. He would have scored better, but Travis Head was the one who was making up many dot balls, and his strike rate was low, because of which the score in 5 overs was less than for 40 or whatever it is. So that could be a reason. So this can be like, head is injured means like maybe a positive or a negative. So the premium is 1200. Now there is a talk going on like a like to like replacement for Travis. It is someone with the caliber of Suryavamshi. So this is, I just so that I mentioned Suryavamshi too. But we don't know the name. It's a newcomer. Suryavamshi, anyway, he plays for RR. So now this youngster is also like a promising prodigy, and they are saying that he will be the next Suryavamshi. So suddenly, like, it's an uncertainty. So in this case, like, premium shoots up. So from 1200, it immediately jumps to 2200. Again, at this point, if you want, you can sell and you can come out in profit. Now the match starts. So when the match starts, and if a toss is bowled and say SRS is batting, and this new person is already in the team. Now the whatever it is, like, it's an election news, it's whatever the news, like global news. Before it comes out, there will be uncertainty. Once it is finalized, then the uncertainty goes back. That is called IV crash will happen, and the premium melts. So now the premium from 2200, it has come to 1800. Now scenario one. Let's have two scenarios. In one scenario, after 3 overs, SRH are already 38 for 0 for no loss. So in this case, like, premium has shot up to 4000. Good that you have not sold when it was 2000 or 2200. Now it is at 4000. Now, so if you want, you can sell it now and you can go, or if you still think like this 4000 can go to 8000 or 10,000 or whatever, you can keep it and hold. So that is totally up to you. So this is one scenario. And now this 4000, like after 5 overs, looks like SRH has scored 60 runs. So whatever the profit, I will discuss detailing in the next video. But for now, you can understand a good profit is booked. So this is a scenario where your strike is 50 and you have scored 60. 60 is the spot. They say like whatever is the actual score is a spot. So now your spot is more than your strike. So it's a call option where you have said like they will score more than 50, and yes, they have scored more than 50. So you have booked the profit. Now scenario 2. In this scenario 2, like after 4 overs, SRH is only at 30 rupees. So now the premium that you paid for 1000 has come to 700. So now you might take a call like just only 6 more balls, they have to score 21 runs. Is it possible or not? If you are uncertain, you can exit even now at 700 with a minimum loss of 300 rupees. If you still hold and if it goes to 0, you will lose all 1000 rupees. Now, immediately after that, the first and second ball are going for 6. So now SRH is already 42 runs and still 4 more balls. So premium shoots up from 700 to 1800. Still 4 balls are there, and if you want, you can again exit, or it's totally up to you. Third and fourth ball were dot balls. So premium again from 1800 immediately shoots to 600. So this is like in the last over, like kind of when we are nearing to expiry, due to the time decay or sensitivity of the premium, there are so many factors where premium like will be like kind of so much, it will be volatile. It will fluctuate like anything. So as you see, like just 4 overs bowled, it was 700, 4.2 it was 1800, again 4.4 it is 600. So this is the kind of volatility you will see when market is moving here and there in the final few minutes of the expiry. So again, fifth ball was a sixer. So again, it was like now SRH is at 48. So from 600 again, it has went to 1400. And the last ball was a dot ball. So SRH after 5 overs, they are scoring 48, because of which your entire 1000 rupees has gone to 0 because they have not scored 50. So intrinsic value in this case is 0. Spot is 48, which is less than the strike of 50. So your premium has gone to 0. So now let's get into a real market scenario where we will discuss what I'm trying to say. So I'm be keeping whatever we saw in the left side so that you can have a reference to that. Now let's come to this. So you are buying a Nifty call option for July expiry at which is the strike price is 24,500. Expiry is July month end. So for Nifty it is like last week Tuesday will be the expiry, and for Sensex it is last Thursday. So you are buying a premium of 60 to 70 rupees. So you are saying like currently Nifty is somewhere around 2450, but you say like Nifty will go to 24 more than 24,500, and you are paying a premium of 70 rupees. If Nifty closes anywhere below 24,500, you will end all the 70 rupees, it will go to zero. Now after 2 days or so, now we are somewhere in the middle of July, so we have at least 10-12 trading sessions. Now after a couple of trading sessions, all global markets are up, and our Nifty also has climbed to 200 points, and it is now at 24,250. These are all like a kind of hypotheticals. I don't know whether Nifty will go to 24,250. Whatever I'm going to say next are like it's a future event, so I'm just giving like kind of a assumption on for this to explain how this works. So at 224, 240, you can see like market, global market is up and the Indian market is also up, and the premium has grown from 70 to 80. And after a couple of days, few more days, like right now, the Q2 results are coming for already. It has come for many companies, and it is due for so many companies in the next weeks. And you can see like many companies are reporting negative revenue, negative profit, because of which again Nifty has come down from 24,250 to 24,90, and premium again has eroded to 75. Now again, very big global news of again US and Iran conflicts has resumed, or it is starting, or whatever you call it, because of which global market again has crashed, and Indian market as well. And now Nifty is at 23,900, and the premium has come to 50. And again, after 2 days or a day, there was a meeting in which again they agreed on ceasefire. And this time they have told this is the final agreement. We will not breach the ceasefire. We are doing this for global good. And so many promises. And because of which again all global markets are rising, and Nifty has come to 24,300, and our premium has gone to 90 rupees. And now let's come to the expiry day. So on expiry day, it's again at 70 rupees, and Nifty is at 24,400. We saw the same 70 rupees when Nifty was at 24,050, and still though market has moved in your favor, it has moved almost 300, 350 points. Still, your premium has not moved an inch. So this is where options is slightly a complicated thing, where even though you predicted the direction to be right, but still your premium is staying at the same level. So that is something that we need to closely watch on. So now at 12 noon, usually the market opens at 9:15 and closes at 3:30. So in this scenario one, I'm just saying like at 12 noon, Nifty is at 24,520, which is like it started at 24,400, it has climbed 120 points, and you are already in the money. Intrinsic value is there. So in this case, your premium has become 90, which is more than 70. If you want, you can book the profit. And again at 3 o'clock, you can see like market has moved again another 100 points from 24,520 to 24,620. You have booked a good profit. I'll explain on how much is the profit in the next video, as I said before. But you have made a handsome return and you have booked the profit. Let's come to the second scenario. In this again, by 12:30, Nifty is trading around 24,350 and your premium has become 40. Now at 1:30, from 24,350, Nifty has moved to 24,480. It's a very big jump, because of which your premium also has jumped a lot to rupees 100. Now again at 2:30, there was 50 points decline, and 24,430 is at Nifty, and your premium is 30. The premium is eroded so much because there's hardly 1 hour left. And after 3 also, you can see like most of the premiums will go to kind of zero if it is way out of the money. So because of that, the premium has eroded so much. But again at 245, there was again a 50 points move, because of which again your premium has come to 80 rupees. But finally at 329, you can see like Nifty was so much closer to 24,500, but it didn't reach 24,500. So the entire amount, whatever you paid, has become zero. So this is the same case that we saw before. So this is how actually premium works. whatever the numbers I say for both the scenario, whether it is IPL betting or for the current like real market, the rupees or the premium that I mentioned is something that I have cooked up with. But this is something similar to like what whenever I say it's rising, it is going down. That is the same. There is no doubt in that. So just a recap. So you can see like strike price, as I said, like in our case of IPL betting, 50 runs is the strike price, and for market it was 24,500 call option. And premium, the price that you for the bet there it was 1,000 rupees, and here it is 70 rupees. And implied volatility is the uncertainty when the new debutant person, like who was a prodigy for CISRH, they bought a like to like replacement for Travis Head. So that is the uncertainty here. And here there was a meeting which was about to happen. End of the meeting, they said that it was a ceasefire, but that meeting was the uncertainty event in which made the premium to increase both the sides. And time decay is like here every ball mattered, and here the time matters. So there is the reason I was giving what at 12 noon what happened, not 1 o'clock what happened, 2:30, 2:45 kind of. An intrinsic value is something like at the end what was your spot and what is your strike price, whether it was actually worth expiring like in the money, at the money, or out of the money. If it is in the money, then you will be making money. If it is at ATM or OTM, you will not make much money. So that's what it is. As I said, like in the money, maybe I can give you one more example, a cricket example on what is ITM, ATM, OTM. So same SRH. Now, like 3 overs, our aim is like we needed 5 overs, 50 runs, which is like 10 runs per over. Net run rate required was 10 run rate. 10 was the run rate required. But when it is ITM, like after 3 overs, just imagine like SRH has already scored 39. In this case, the already the net run rate is 13, but required is only 10, which is easily achievable. 10 is not required. 10 is like overall required when the match before it started, but now it's like only 2 overs, 19 is needed, which is less than 6. So obviously this is in the money. Similarly, when we said like 24,500 is our strike price, and if market is at 24,800, it is already in the money. Similarly, say suppose after 3 overs it is 30 runs. Now the current run rate is 10, and the required run rate is also 10. So this is like kind of exactly in the money. Sorry, at the money. In the money is already we are in a good favor. We are in favor of what we have betted. But this is like kind of neck to neck. It is like the asking rate is also same, and the current net run rate is also same. Similarly, if like 24,500 was your strike price and 24,500 is a spot price where market is currently trading. And OTM is like say suppose if after 3 overs SRH is scoring only 21 runs. So here the current run rate is 7, but the net run rate, the asking rate is like in 2 overs they need 29 runs, which is like almost 14.5. So that is very difficult. It is like a OTM. Similarly for market, it is like say suppose 2400 is where market is, and your strike is like your strike is 24,500. So it has to climb a lot to get into that. So that's what it is. So as I said before, also like being right about direction isn't enough. So as I said, like 24,050 is where we bought the premium for 70 rupees. But even when market went to 24,450 or 24,4 somewhere whichever I explained, still there it was like premium was still 70 rupees, though market has moved through 350 points. So that is the problem with option buying. So direction, magnitude, timing, all have to line up before the expiry. If something goes wrong, your premium will go to zero. So that is the catch there. That is one of the reason like why 91% of the people in options are losing money. That is something everybody knows. If not, please know that before entering into an options trading, because SEBI keep on warns everybody that don't enter without knowing things. So please know that out of 100 people who trades in options, 91 to be exact loses money. Only 9 people make money. So this is purely for educational purpose. If you want to understand more on options, I have an experience of 10, 12 years in market. So I can explain my journey and whatever do's and don'ts in my perspective. If you like that, you can continue with this and you can understand more on this. So in the next video, I'm going to explain like when I said like we made a handsome premium, we made a handsome profit. I'll explain how much money we have made in those trades and how to calculate that and whether that is good And I'll also explain option buying or selling. As I said, for option buying, not just the direction, the magnitude, the time, so many other factors also there. So is it worth being an option buyer, or there is something called option seller? You can sell before you buy. So that is one more thing. So those concepts we will covering in the next video. If you are interested in that, please do subscribe to this channel. And there is a Telegram channel as well. Please follow that. And we will be seeing you on the next video. Thank you.